Good afternoon, everyone. Welcome to our February webinar, which is co-hosted by PHCC of Long Island and MACC. My name is Collier Curran, and I am the Association Manager for both MACC and PHCC. First, I'd like to thank you all for supporting MACC and PHCC during these difficult times. We've been working really hard behind the scenes to keep our associations active and to provide consistent value to our members. Webinars like this one have been a great way to simultaneously inform and engage with our membership. As a reminder, all of our webinars are recorded and sent out to membership, usually the next morning. So if you'd like to watch the webinar again, or you know someone who was not able to log on tonight, definitely keep an eye out for that email from us so you can access that webinar anytime. So tonight's webinar will consist of a presentation from Janover LLC. Janover is a premier accounting firm specializing in working with HVAC contractors, and that will be followed by a brief Q&A. So please, throughout the presentation, submit any questions that you have using the Q&A function, and they will answer those either during the presentation or at the end. We do want this to be as informative as possible, so please don't be shy with asking questions. They're here to help you out. So if any questions come up after the webinar is finished, definitely take down the presenter's contact information. You can see it right there. You can always shoot them an email, or you can always call or email the association office and we can forward your question. So now, without further ado, I'd like to welcome tonight's presenters, who are Joseph Tanser, Barry Sunshine, and Chris Singali.
Thanks, Collier. Appreciate it. Good evening, everyone, or at least evening from where I'm sitting in New York right now. We are really excited to be here today. As Collier mentioned, we're with a CPA firm named Janover. We're based in New York, but we have clients across the country. Barry Sunshine and Joe Tanser are two of our senior tax partners at the firm. And I'm a principal at Janover. I run our firm's digital advisory solutions and our consulting department. Just in terms of what's coming up for this webinar, bottom of this page, please read it. We're offering this webinar as a learning experience. We're providing content and general guidance. Because of the nature of what we're talking about, things can change very quickly. Myself, Barry, and Joe have actually done a webinar where as soon as we've got off that webinar, about an hour later, the IRS had released certain guidelines related to something we were talking about. And what we spoke about became, or part of it became somewhat stale. So because everything is changing so much, just in terms of using our deck, relying on our deck and the information that we're presenting in here, just kind of, use your own resources in order to finalize some of these solutions and analysis. In terms of what we're going over today, we have a really packed agenda. I think we have a lot of good stuff to go through, a lot of important stuff, and we try to focus a lot of what we're talking about based on questions we get from our clients and other people in our industry group. So what we're going through today is some certain clarification and new guidance related to PPP first draws. That would be the first draw that you as a business potentially took back in March of April of last year. And first draws also include people who are getting money for the first time around now who didn't take a first draw back in March of April of last year. Then we're going to introduce some key provisions related to second draws. We're going to go through really high level, some tax implications and financial reporting of forgiveness of PPP loans. Finally, we're going to touch on the employee retention tax credit, which at this point of the game is probably one of the biggest topics we as a CPA firm are talking about with our clients, and we're seeing the most questions from our clients come. So this is a really important piece. A lot of people know some of the ins and outs of the PPP, but you may not be as familiar with the employee retention credit. Finally, we may get into the shuttered venue operators grant. There's some bonus content. It's a new program. While it doesn't affect probably many of you on this call, it is another SBA program that we do mention if we have some time at the end. So getting into this, just so we could get an idea of our audience and understand kind of who's out there, because we do tailor our presentation somewhat to the audience as we go through. First question is, what was the amount of your first PPP draw? It's 150 or under, 150 to 2 million, over 2, you didn't take a first draw, or NA, you're just here so you can learn a little bit more. I'll keep this open for maybe another 10 seconds, 30 seconds or so total, just so we could get an idea of who's out there right now. Okay. So it looks like based on the results, we have no one who got over $2 million. So that's really good to know. That part of our presentation, we will scale that back a little, and we'll just kind of touch it at a high level. So pretty much, well, everyone on the call is below the 2 million threshold. So that's really good to know. By way of introduction, the Consolidation Appropriations Act was signed into law on December 27th of 2020. At this point, I think everyone may know that, right? It had a $2.3 million trillion price tag, which within that was about $900 billion worth of COVID stimulus relief. And the top two bullets here are probably the biggest factors of that COVID stimulus relief. That first is expansion, a pretty wide expansion of the employee retention tax credit, more available PPP funding, and then you have some extension of certain deferred payroll taxes. And then, as many of us probably know, there are some unemployment benefit extensions in here. Just to put into perspective, in terms of PPP size, the CARES Act, which was that bundle of PPP that got released back in March of last year, that was about $660 billion. Only about 520 billion of it, which was funded. So about 130 billion went unused, and that 520 funded about 5 million businesses. To put that into perspective, the funding that's currently sitting with this updated PPP is about $285 billion. So it is a smaller pool, but while it's a smaller pool, it is more restrictive. So the guidelines in order to receive the money are much more scaled back, and smaller businesses are able to get funding now. So it's a fraction of the size of the first one, but also a fraction of the businesses are actually eligible. So we're going to start with changes to first draw PPP loans. And on that note, I'm going to hand it off to Joe Tanzer to take you guys through this piece.
Well, good evening, everyone. Chris, thank you for getting us off to a great start. Always good to hear your presentation. So as Chris mentioned, there was a very big law passed at the end of December, and it made a lot of changes to the PPP program, which was already a very popular program when it first started. But the changes are actually designed to make this better for people, easier for people for the most part. And there were a lot of changes that were made, not only to the second draw for those people who got in the first draw, but also to the first draw. So for those people who had not finished the forgiveness process, there was a lot of opportunity to take advantage of some of these new rules. And it also, as Chris said, a first draw means not only the money that was taken back when the program started, but also if you hadn't taken a draw before, and I guess everybody on this call has, because based on the polling, but even for somebody who hadn't, now is a chance to get a first draw. So we'll talk more about the second draw a little bit later, but let's talk about some of the changes that took place. For all of you who have not gone through that forgiveness process completely, some opportunities exist here. So as was originally designed, you still have all of your payroll-related costs that you could use for people who are residents of the United States. You had the rent, mortgage interest, and utility payments. All of that stayed in place. You'll recall that the payroll-related costs must be at least 60% of the borrowing and 60% of the forgiveness amount. But in addition, this new law opened up 4 new categories. So these 4 new categories make it not only easier to qualify if you don't have the cost in the first part of it, but also it gives you an opportunity to play around with the employee retention credit, which we're going to go into great detail later on about. Because by picking up some of these other categories now, assuming you're still over 60% payroll, you can maybe move some of the payroll costs that you would have otherwise dedicated to PPP and use it for the employee retention credit. Again, we'll go over that in greater detail later. So let's go through some of these categories here. So operations expenditures. This is a great category for most businesses. It means basically any software or cloud computing services that you use in your business. It's because it's those services that facilitate business operations. Okay, so as you can see on the screen, processing, payroll, HR, you got your billing and supplies and inventory and all that stuff. That really is basically all you need to run your business, whether it's software or cloud computing. Those costs that you paid during the covered period will qualify as permitted uses and subject to the forgiveness. Probably the next biggest category would be the worker protection category. This one pertains to expenditures, whether they are expenses or capital type expenditures. This is to make your workplace safer for your customers and your employees. So if there were expenses that you incurred to sanitize or keep your people socially distanced and other safety requirements, the examples that usually come up are like the plexiglass sneeze guards, some barriers. You can maybe have your gloves and your sanitizers, temperature scanners, and even if for some reason you had built an outdoor space where you could work so you wouldn't be confined just to the indoor space, all of that counts. So again, making everything just that much easier to qualify. Supplier cost is probably the third most common. Supplier costs in your industry probably would be for your tools and your hardware. We're talking about essential goods to make your business run. And as long as you had a contract in effect by February 15th of 2020 and paid for it, before the covered period, I should say, right before the covered period, and then you actually spent the money during the covered period to pay for those supplies, then those all count. The last category probably doesn't affect many of you. This is related to property damage that might have been sustained during the protest that took place in 2020. So obviously there was some vandalism and looting in certain cities and certain parts of the cities. So if you had to spend money to repair or replace damaged property, that would qualify as well. Let's go on to the next slide, please. So as Chris mentioned before, we're not going to spend much time on the $2 million, the loans over $2 million. But I want to point out that as we get into the forgiveness applications, which is at the bottom of this page, we're going to just say that you have to do a special requirement. It's a special questionnaire if you're over $2 million. Maybe some of your friends have this or business associates, but we won't really spend any time on that. So with respect to the covered period, you can pick 8 weeks or 24 weeks in the first part of the program. Only certain people could use the 8-week period. Then now it's open to everybody who's taken a first draw, whether it's in the past or now. And also, you could actually pick a period in between if you choose to. You feel like doing 21 weeks, perfectly okay. And some people may want to do that. And you may ask yourself, well, why would I take a shorter period? Wouldn't I be better off with a longer period? The answer is, generally speaking, you would be better with a longer period, but sometimes it actually pays to shorten the period. As you probably know, there are certain reductions in this program that if you lower your full-time equivalents, what we call FTEs, or if you have salary reductions, that can lower the amount of forgiveness that you're entitled to. And if you anticipate that happening after I'm going to make this up, a 20-week period, you might want to cut it off at 20 weeks before you lose that money in reductions. So there are, for most people, there really are three applications for forgiveness. The 3508S is for loans that are under 150 or up to 150. So the ones that are under 150, really you're just signing off. You don't have to explain anything to anybody. You just sign off that you are following the program rules and you told the truth on your application. And then theoretically, you should be okay to sail. You send in the 3508S and you should be getting your forgiveness within a short period of time. For loans that are between 50 and 150K, you do have the same form. So it's really the same sign off. The only real difference here is that you need a little bit more documentation in the background, because you would have to eventually prove that you did have no FTE reductions and no salary reduction, or if you did, that you took a deduction for those reduction elements. There's a form 3508EZ for loans that are greater than 150, but you can only use that form if you can certify either that you had no FTE or salary reductions from the beginning of 2020 to the end of the covered period, or if your business was closed due to COVID by an order from the government, which may in fact have affected some of you in your workplaces. And then other loans just use the 3508. That's really for those that are greater than 150,000, and also those that cannot make those certifications. Next slide, please. Okay, so some other changes. So some of these we can go through a little more quickly. That you may recall that there was another loan called the EIDL, and that was a grant at one point. You could get up to as much as $10,000, and then you had to subtract it from your PPP money when you got forgiveness. Well, now you don't have to subtract it anymore. And we found out by this new law that the EIDL grant is not taxable. So that was a good thing. The employee retention tax credit eligibility, we're going to go into that in greater detail later. So let's just pass on that one. Just know that that's a nice change. The only reason why it's on this page is because now you can participate in both programs, the PPP and the employee retention tax credit. Whereas before this new law was passed, you could only participate in one or the other. Just so you know, we know that there are websites out there that are telling you you cannot participate in both. Most of those are just outdated. So if this is where you're hearing it first, that's wonderful, but you can participate in both. The loan calculation. This didn't change that much, except that instead of using only calendar year 2019 or the 12-month period leading up to the loan disbursement date, you can now use 2020 if that works out better for you. So the multiple is 2.5 times the average monthly payroll. I'm sure you may recall that from your original application. Next slide, please.
Yeah, and Joe, just one thing to add there on that note, that some websites are saying that, you know, the ERTC and PPP can't both be used. I think even the IRS website still currently reflects that. The IRS website still hasn't been updated from the law that got passed at the end of 2020. So that's just another thing to throw out there.
Maybe we should have invited them to the webinar.
Yeah, yeah, we could help them redraft the FAQ.
Thank you. All right, so this next point is a real big one. If you're going for a draw, whether it's the first draw or the second draw, you need to make your application and actually receive the funds by March 31st, 2021. Otherwise, you're not going to be able to get it. So, you know, make sure you sharpen your pencils and get out there and start working on this. On point number 8, and that is that some entities that were not eligible before can now be eligible. They cleared up that housing corporations housing cooperatives can be eligible, but instead of the 500 employee, like most companies, only 300 employees can be eligible there. And the same is true for business associations, which are governed under 501c6. And then there are some other eligible businesses, but don't really apply much in this context with you guys. And then one other point is that, as you may recall, the payroll costs, which include your salaries, your gross salaries, it also, with limits, of course, with salaries, it included your state and local taxes that you paid. It also included retirement costs, and it also included health insurance. Well, now they've expanded that to include group life and disability insurance premiums as well. And all of that fits into payroll costs, so therefore it works towards the 60% for the forgiveness, and everything works out really, really nicely. So these were these changes, and that they're really helpful to us. At this point, I would like to turn this over to my partner, Barry Sunshine. Barry is a tax expert, a real top-notch. He's got a lot of really good ideas, and I'm sure you're going to get a lot from what he has to say. So Barry, go ahead.
Thank you, Joe, and good evening, everybody. That was a great thing, and we talked about what Joe was talking about on the first draw, how you're trying to manage and get maximum forgiveness. Once you get forgiveness, there was a lot of uncertainty last year as to what is the taxability of it. And this law passed, and what they did is they reconfirmed that any of this PPP loan that's being forgiven and you don't have to pay back is considered tax exempt income for income tax purposes. And for most of the local states, Connecticut, New York, and New Jersey, it's not going to be subject to income taxes. In addition to that, which gave a little uncertainty last year was whether these expenses that were funded by PPP loans that were forgiven, whether those loan expenses are actually tax deductible. And this law came out and said, to the extent that these expenses are fully deductible, like salary expense, health insurance, and whatever other costs you may have, those too are fully deductible. So what you got is, people think that you're got a good little vig in there and that you got the expenses that were funded with non-taxable income fully deductible. And then to add attraction to on top of it, that if you're operating this forgiveness income, it's going to increase the owner's income tax basis, whether you're operating a partnership, sub-S, or whatever type of entity you're using, using to operate your business, you're going to get an income tax basis. So this is really going to create a great opportunity and a great little vig on the income tax play on this for business owners. So this is all good news, and that's terrific. Now, next slide, Chris. What we're talking about now is, I'll call it the second draw. So a lot of companies got PPP money in the first draw. Now the second draw is out. And the reason why Joe went over the first draw is there were some companies that chose not to go and get PPP money for the first draw. So what they could do is they can go under this new round or this new second draw and actually get funds based on the first draws if they didn't get it. The second part of it is if you did get PPP money in the first draw, you can get a second draw, provided you get you qualify. And some of the qualifications are, some of them are the same as before, some of them are different. But the first one, which I can't emphasize, underestimate, this is a very big item. It is one, you must certify economic uncertainty that makes the loan request necessary to support ongoing operations. And what this means is whether it's the first loan or the second draw, you really need to demonstrate a financial need for this money. If you don't have a financial need for it, then the SBA probably is going to say you're not going to one, you may not be able to get the money, but secondly, they're surely going to go back and say you couldn't demonstrate a need, a financial need. So you're probably not going to get any forgiveness on it. Some companies are taking the chance of saying, well, maybe we don't have a financial need. It's a little gray area. So we're taking a chance and then we'll just get apply and we'll leave it for audit. It's not a good thing to do. And what we're recommending companies to do is draft up memos, internal memos, something to the files saying that you have an economic need. Just going through some of the other criteria, PPP first draw required 500 or less employees at the time of applications. This is a more target. The second draw is more targeted. You can't have more than 300 employees. And in addition to that, for setting the second draw, you have to experience a decline in your gross receipts of at least 25% in any one quarter of 2020 compared to 2019. And that's on an affiliated basis. So what it means is in Q2 and Q3, a lot of these construction contracting businesses were either closed or operating at much more reduced levels. So their gross receipts have decreased greatly. So if you had, I'll make a number, $100 of revenue in Q1, and you could just multiply it out, in Q1 of 2019, you have to have a 75 or less in that same quarter the following year in 2020 to be eligible. They had some technical rules which existed in the draw one was you can't be an ineligible small business concern. There was specific industries, certain businesses that were not allowed to get PPP money because they were not eligible SBA borrower. So those companies were those in the business of lobbying. If you were a financing company, you were not eligible for it. And there were certain real estate entities that were not eligible for it as well. So you have to be an eligible small business concern. Also, to get the second draw, you have to have spent your first draw PPP money. So if you got $100,000 and by the time you file this for the second draw, if you didn't spend all your money on PPP 1, you're demonstrating a need, and that was one of the criteria to get the second draw. As Joe alluded before, you have to apply and receive your money by March 31st. Now, there are some banking rules. The SBA came up with some banking rules that if a company applies for a second draw, the banks have to process these loans within 10 days. Now so you have to apply by March 31st to ensure that you're going to get it by March 31st. And that requires a complete application. We don't believe that like last year when people were all lined up and they ran out of money in PPP money, we don't feel that that's going to be the same, and that holds true because this is more targeted. So there will be plenty, we believe that there's plenty to go around. But if you're looking to get this money, we're saying to people, don't delay, please put in your application. And also loans are capped at $2 million per business and $4 million for an affiliated basis. Next.
Hey, Barry? Yeah, so with the economic uncertainty issue, which I agree is one of the most important things. So if the business is under $2 million, they don't actually have to submit anything that proves this, but should they really look into this and make sure they're documented anyway, just to make sure that in case they get reviewed, that they can prove it?
Yeah, Joe, I mean, it's a gray area and it's a great question. I am more conservative because, I mean, whether you got $100,000 of PPP money or you got $2 million of it, every business, that's all relative to each business. It's a lot of money. So I still feel very, very strongly that every PPP borrower should have a memo in their file to document that there is a necessity for financial help. I'm a believer of it. Maybe I'm a little bit more conservative, but I think that makes you sleep at night and gives you less, problems in the future. So that's a good point. Thank you very much, Joe. That's an excellent point. Next slide. The next thing is when we talked about small business concerns and eligible ones, they clearly came out with these rules and they added some new categories of who it cannot participate in this second draw. And one of them are publicly held companies. If you were not in operations on March 15, 2020, you would not be eligible. If you're recipient of a shuttered venue operator, we'll cover it later, you will not be able to be eligible for PPP money. If you actually applied for a second draw and you got it, you're not going to be able to get any additional PPP money on the second draw. And there's other entities here listed below as well. But you just want to make sure that you're qualified and all that kind of stuff. So it's all important things. A lot of your businesses do qualify as a contracting business. So I think that's all good to have, and as well as to document. Next slide. Now we talked about gross receipts. You have to have a decline of 25% in any single calendar quarter in 2020 compared to 2019. And you have to demonstrate that. That makes so if you're using the percentage of completion, or you're using completed contract, or you're using work in process, percentage of completion, whatever method you're using, accrual or cash, you're using your normal income tax basis reporting. That's what the SBA rule is, and that's what the same rule is for under the income tax laws. And this rule of gross receipts is a similar definition as it is for the employee retention tax credit, which Joe's going to go over in a little bit. But basically, you're going to have to calculate your gross receipts for these quarters. And if you have a decline in gross revenues by this number, you will be eligible for it. Now, what's interesting is some companies, some contractors have multiple businesses. They may have 5 or 6 businesses, 2 or 3 businesses that one owner may own, or multiple owners may own in similar percentages. You have to do this calculation, not for each company, but on an aggregate basis. You have to aggregate the gross receipts for all of your affiliated companies, okay? And there's some special rules that if you were not in business for 2019 that you need to attend to. But let's just take a quick look at what gross receipts includes. It includes sale of product or services. And again, it uses your normal method of accounting for tax, percentage completed contract, accrual, cash, or whatever method you're using. It includes interest, dividends, rents, royalties, fees, commissions. And if you have any sales, it also reduces by returns and allowances, okay? It doesn't reduce it by cost of goods sold, meaning the cost of product, but it allows you to reduce it by returns and allowances. So that's it. What items do not get included in gross receipts is, obviously, if you had any PPP forgiveness, that's not included in your calculation. If you collected sales tax and you're remitting it over to the state, if your method of accounting includes in revenue sales tax collected that you're going to repay to New York State, or for that matter, any state, that doesn't include it. And any intercompany transaction. So if one company buys product from another company of a related company, those revenues that are from intercompany transactions can be excluded. And in addition, if you have any capital gains, if you sold a piece of equipment, so if you sold a piece of equipment, that too is excluded from this calculation. So, so these are looking at normal business receipts and so forth for purposes of this. And this same calculation, which Joe's going to allude a little bit, we'll talk about later on, applies for the employee retention credit. So this is an important slide, and I can't underestimate how important it is. The next thing we're going to go over is I'm going to turn it over to Chris Zangali, and he's going to go over the necessary documentation that every business should maintain.
Thanks, Barry. Thanks, Joe. Great job, guys. So just in terms of time, because it looks like we have another 20 minutes or so, I want to make sure we have enough time for the employee retention credit piece of this. So I'm going to go through these next couple of slides in fairly short order. So if you have any detailed questions about anything I go over now, feel free to put in the Q&A and we'll respond to you directly. So in terms of the documentation requirements, what we found is that the SBA has a set of documentation that they require in order to take the second PPP draw. What we've seen though in our experience working with a number of lenders and financial institutions is that they require what the SBA requires, as well as anything else that they feel like asking for. So the process in terms of documentation hasn't been as smooth as we saw the first time around. It's just that the SBA and lenders are a lot more diligent this time around with who they're giving money to. And it's not as much as as loose as it was the first time around. So in terms of the gross revenue reduction, requirements per the SBA and the Treasury Department are a tax return if available, otherwise financial statements and/or bank statements. And those would be key financial statements showing that decrease in the 25% decrease in gross receipts year over year. In terms of loans under 150K, for those of you who've already applied, you may know that you weren't required, or you may not have been required to submit support for the reduction in revenue with your loan application. But however, we should note that you will be required to submit that documentation on or before your forgiveness application of that loan. So just keep that in mind, that they will ask you for that at some point. For loans over 150K, you may know that you were required to submit documentation at the time you filled out the application. One thing, and I put it here in a separate bullet, that financial statements must be signed by the owner or whoever's signing the PPP application. They do have to sign and date those financial statements, assuming that the financial statements are not audited. So that's something we've been seeing get pushed back. It wasn't a requirement originally. It came out in a subsequent IFR or FAQ, and that is something that we've been seeing is a result of applications getting pushed back to the borrower. If for payroll support, you may know that if you're going through the same lender, we should note that if you're going through the same lender and you're using 2019 payroll, you're not required to resubmit payroll documentation. That's an SBA rule, with the caveat that lenders may request additional documentation if they find it useful in doing their review. Every single application we've seen at this point, they've required that the borrower to resubmit payroll documentation, even if they were, again, using their 2019 payroll. Another item to note, you may be required to submit a 2019 or a 2020 tax return. Some lenders are requiring this, some aren't. So it's really gonna vary based on the institution. Really quickly here, how the loan is calculated is very similar, if not almost exactly the same as the first draw. However, this time around, as Barry mentioned, loans are capped at $2 million per entity or $4 million for affiliated companies. And they're calculated, so it's the lesser of 2 million or 4 million affiliates, or 2.5 times your average monthly payroll for either the calendar year 2019, 2020, or the trailing 12-month period prior to the loan disbursement date. Seasonal businesses can use an average payroll for any 12-week period between February of 19 and February of 20. We don't have anyone on this call, so I'm guessing we don't have anyone on this call in the food service accommodation and food services. So I'm not going to spend a lot of time there. But for those businesses that in the restaurant hotel industry, they were eligible to take 3.5 times their average monthly payroll cost, so slightly higher than all other industries. Financial statement reporting. The 2 bullets here, I like to cover the second bullet first. Requires management's judgment, no one-size-fits-all answer. We recommend that if you are furnishing financial statements this year, that anyone is, a lender is requiring financial statements, do make a judgment call and do what's best for you, what works for your business, what works for your lender. There's no one-size-fits-all answer here. work with your accountant, whether they're internal or external, and decide which of these three scenarios is best for you. But in real summary form, there are three options for reporting the PPP on your financial statements at the end of the year. The first is to treat the PPP as debt. So that's just going to basically sit as a loan on your balance sheet. It's going to show as if you owe a loan at the end of the year, and you're not going to extinguish that liability and take the income until it's legally released by the SBA. So that's until the SBA gives you your forgiveness, your results of your forgiveness. The second piece is that you recognize deferred income upon receiving the loan. And if the company believes with reasonable assurance that the loan will be forgiven, you can recognize that income over the period the expenses are incurred, which would in theory be, well, for the first draw would be during 2020. Again, depending on when you got your loan, if you got it later in the year, it may kind of trickle out to 21, but for the most part, you would take the income in 2020. The third is a gain contingency. Basically, it will just show up in the notes to your financial statements. And similar to one, you won't recognize any income until the SBA extinguishes you of that debt, until you get the letter from the SBA saying you're forgiven. Again, if you have any questions on what I just went over, I know it was quick. We're just short on time, so feel free to drop a question in the Q&A if there's anything specific a question that you have on any of those. Let's hand it back over to Joe now to take us through the forgiveness timeline and I believe the ERTC, right?
Yes, Chris, thank you. Thank you very much. Yes, so this actual slide here is the last one we're going to go on the PPP. And so really, I don't want to spend much time on this again. We're trying to save some time here. Just to tell you that the process for forgiveness really should take maybe up to 150 days because the lender has up to 60 days to review it just to make sure everything's in order. They hand it off to the SBA. The SBA has another 90 days to do it. Most likely it's going to be less than 150 days, but it could be up to that much. And just to let you know also that they can actually audit you for up to 6 years. You have a requirement to keep records for that. Employment records must be kept for at least 4 years. Well, we always tell our clients to keep it for 7 years anyway, so that's not a problem. And for other records, other than employment, they require 3 years. Next slide, please. Okay, so I'm really excited to do this slide. It's one slide, but it's quite a bit on here, actually. The employee retention tax credit was sort of passed over a lot by a lot of businesses in 2020. Mostly because you could not participate in the Employee Retention Tax Credit Program as well as the PPP. Well, the law got changed and now you can participate in both programs. The big caveat though is that you must use payroll costs in one or the other so that you cannot use the same payroll costs that you use for PPP when you're using the Employee Retention Tax Credit. And that is by far the most important part of the planning. How to separate that which should go into the PPP pocket versus that which should go into the ERTC pocket. This is something that our firm is working round the clock now to do for our clients. We are immersed in this project because it's very complicated. There's a lot of overlap in the periods. And so you have to really be careful about how you move things around. As I mentioned earlier on, those new categories that are available for the PPP make it a little bit easier now to keep the payroll costs maybe at 60 or 61% for PPP purposes, freeing up payroll for the Employee Retention Tax Credit. Or looked at a different way, since the Employee Retention Tax Credit is based on, for 2020, it's based on a $10,000 salary for the year, just making sure you have the most you can use there, and then the rest goes to PPP. But we go back and forth on this because you can't really tell until you put all the numbers down. So how do you get this credit? Well, for 2020, you've already filed all your 941 forms, which is the FICA and the federal withholding tax forms every quarter. So to get money back on 2020, now that we have new rules, you actually have to amend your returns. You might want to speak to your payroll provider about that. But before you do, make sure you run the numbers or ask your tax advisor to run the numbers for you so that you can see how much you actually are entitled to and which payroll applies. Because you might be, let's say, amending the second quarter return. You might be amending the third quarter return, the fourth quarter. You're not sure until you actually run all the numbers. So let's start off with who qualifies. In order to qualify, you had to have had a 50% or greater reduction in a calendar quarter 2020 versus the corresponding calendar quarter in 2019. And the only exception to that rule is, again, if your business was partially or fully suspended because of a ruling for COVID, you could use that and qualify as well. What expenses are eligible? Well, we're talking about wages, the gross salaries, and we're also talking about health insurance costs that you paid as an employer, but only counting from March 12th, which is pretty much the start of when the pandemic really started to spread, and from March 12th to December 31st of 2020. So to figure out which quarters apply, you first make a calculation. When did it start? When did you first have a reduction of at least 50%? Which quarter was that? Let's say, for example, it's the second quarter. Then, so therefore the second quarter, it would apply. But then you're allowed to continue. And you don't have to even get to the third quarter. You don't even have to get to more than 50%. If you're at a point where you are less than 80% of your gross income versus the prior year, in other words, a reduction of 20% or more, then you can continue and in fact even go to the next quarter. Because if you get to 80% or more, or a reduction of 20% of less, said another way, you still get that third quarter, but you cannot go any further. So you finally end off and use the quarter in which your gross receipts get up to at least 80% of the prior year's quarter. How much is the credit? Well, as I said, it's based on up to $10,000 of wages and health insurance. So 50% of that, which is the credit amount, could get you as much as $5,000 per employee. And if you got lots of employees, you can do the multiplication on that. There's very big money to get out there here. That's the way it is. So we're seeing really tens of thousands, hundreds of thousands, in fact, even some cases, millions of dollars coming back as refunds for our clients. And we're working on this. What we're doing, we've told our employees that when they're working on year end for tax purposes, to start giving us data by quarter so we can do this analysis as well, to make sure that our clients get the refunds they're entitled to. And that's really important. Then there's also a credit for 2021. At this point, it only applies to 2 quarters. It's the first quarter and second quarter of 2021. But this one is a more liberal credit than the one that applies for 2020. It's more liberal in a few ways. One is that it only requires a 20% or greater reduction instead of 50% greater reduction. And in comparing quarters, if for some reason your first quarter 2000, and again, you're comparing 21 against the quarter in 19. But if for some reason it doesn't work out for you, where your first quarter 21 is not greater than 20% reduction versus 19, you could even look back to the fourth quarter of 20 and compare that to the fourth quarter of 19. If that one happened to be more than 20% reduction, you can still do it for the first quarter of 2021. They just liberalized it for everybody to make it easier. And first quarter and second quarter wages and health insurance are counted. Which quarters apply? Again, at this point, it's only the first 2, but it's based on that 20% reduction. We expect that they may wind up extending this again, especially if another round of relief comes through for people. Here's a big thing. How much is the credit? It's still based on $10,000 of wages, but there are two significant changes. One is that it's going to be a 70% credit. So that's 7,000 instead of 5,000. And it's by quarter. So instead of for the whole year, like it was in 2020, you can get actually up to $7,000 per quarter per employee for a total of $14,000 per employee. Again, you have other employees, lots of employees, do the math. We are convinced that there's lots of money out there for everybody to get. In some ways, we're even surprised by this. I want to just tell you about a couple of very important rules, though. One thing is that the credit is a reduction of your tax expense deduction for payroll. So whatever you get as a credit is effectively taxable income because you have to reduce your deduction. A second very important rule is you need to know how many employees you have on average in 2019. So if on average in 2019, you had under 100 employees, then you can use that credit in full for all of your employees for both 2020 and 2021 if they apply. But if you had more than 100 employees on average in 2019, then for the 2020 credit, you can only use that credit for paying workers that were actually not working at the time, basically they were out on furlough or some other leave, and you continue to pay them. So that's only if you had an average of more than 100 employees in 2019. When it comes to the 2021 credit, you can continue to take all of your employees up until 500. Once you hit 500 employees, then if you have more than that, then you can only use it for those non-working employees. But that's a big jump. And we're finding that some who were limited in 2020 are all of a sudden allowed to take it for 2021. So at this point, I would like to turn this back to Barry. And Barry, please finish us up. Thank you.
Thanks, Joe. And we were looking at some calculations of a particular client just a little while ago, and they had 50 employees, and and we found out that they do qualify for the employee retention credit. And when Joe says do the math, 50 employees at $14,000 is a $700,000 tax credit, so they can reduce their payroll taxes by $700,000 or get a refund of that. This is a big, and that's in addition to the PPP. Now, if they can go back and qualify for the $5,000 per employee credit, that increases the credit from $750,000 to $950,000. That's a lot of money for these businesses. So, not to be taken lightly. And this is real money. We have something that came up. A lot of our contractors own real estate, and they're landlords, and they're renting properties to different venues and different people, and whether it be commercial or residential. But some of our clients who are operating business, contracting businesses, own real estate or renting real estate out to on a commercial basis to, I'll call it shuttered venue operators, which are basically the people who are putting on live venue shows, promoters, theatrical producers, live performing arts, motion picture theaters, and they're not collecting rents. So what it is this. The reason why we have it here is if you operate one of these shuttered venue operators, the government is giving you a grant in lieu of the PPP, and this grant is based on 45% of your 2019 gross revenue, okay? And you could use it for various expenses. And the various expenses is for payroll, rent, and other costs involved in opening up and reopening your business and hiring people back and so forth. You have to qualify, you have to be in operations as of February 29, 2020, and you had to experience a gross revenue reduction of 25% or more in 1/4 of 2020 versus 19. So those are some of the big things there, and this is helping our clients, our real estate operators and shuttered venues to get money so they can do what they need to do. We have a now polling question, which is our second polling question and the question is, would you like someone from our team to contact you to help you with the PPP calculations, draw 2, draw 1 to maximizing it, as well as the employee retention tax credit, because we're finding out a lot of people need assistance, a lot of help, and so forth. So answer these questions and we'll do that. Now, a couple of seconds more.
Yeah, you could bring it home, Barry.
Yep. Okay. And now the next thing is the next steps that we're doing. And this is what we're saying is our takeaway from this this webinar and this conversation. First, we want to thank everybody for listening in, paying attention, and appreciate everybody's cooperation. But these are true tax incentives and true grants, not to be taken lightly. The first thing we're telling people to do is go back, look at your quarterly gross receipts, and determine if you're eligible for the second draw or the employee retention credit, because this is real money and this is heavy duty stuff. And this is really can bring your business, get you some needed monies for your business. The next thing is figuring out what your covered period for your PPP. That's important. Your covered period starts when you receive either your first draw or your second draw. The definition didn't change, but as Joe alluded to, for your covered period, you can pick 8 weeks, 24 weeks, or anything in between for purposes of the second draw. And it's important because you're trying to maximize the PPP, and if you got the employee retention credit, you can't double dip on the wages. So lengthening the covered period makes sense. Look, this is very complicated. Contractors are not used to doing this. There's a lot of tax incentives offered besides the PPP and the employee retention credit. There's a lot of other credits like the research and development tax credit. The key thing that I'm saying to people is work with your tax advisor, work with your advisor to assist you with your loan application process, the forgiveness application. Keep them involved or her involved in the tax credit calculation, because any credit you leave, you're leaving money behind, and you don't want to do that. Work with your bank and your lender and understand the timing and the procedures in your second draw and loan forgiveness program. These are some of the big key point takeaways to do it. There's a lot more. And at the very end of our slides, we have a matrix to help you work through which application to get for your loan forgiveness. And on that note, I really want to Joe, on behalf of the partners of Janover, everybody in Janover, as well as Joe and Chris and myself, thank you very much for attending. And everybody have a good evening and be safe.
Thanks, everyone.
Thank you so much to Barry, Joe, and Chris for putting on such a great presentation. Everyone, if you have any lingering questions, please take down their contact information. Please feel free to reach out to them. And I also want to thank you all for logging on and for your continued support of PHCC and MACC. I hope you all have a great night. Stay safe and be well. Thank you.